please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Welcome back. It's a pretty tough day actually today, I'll have to say. I mean, you could say that in the morning the SGX Nifty was down 250. You know, we are ending with about 130 point downtick. The mid caps at the index level are still in the green, so that way still okay. But large stocks, there's some problem with the large banking names, large financial names. So that's dragging the markets. The HDFC Twins, ICICI Bank, even Larsen & Toubro, some of these stocks have moved to the low point of the day, but the broader market has done well today. So good time to get you the BTST calls. So buy today, sell tomorrow. In this case, of course, the reverse trade happens on Monday. Ashwani and Mitesh with us for that. Ashwani, you go first. Thoughts on index, the bank Nifty, not quite at the low point, but getting there, and individual stocks?
See, it is at the low point. I think at worst it was 550 down. We are going home with 500 down. So I think banks remain particularly weak. So that way, you know, if people have any sort of positional bank Nifty shorts, they can be carried. Nothing changes here. As far as individual stocks are concerned, Yes Bank is a sell with a stop of 330, target of 315. Torrent Pharma is a buy with a stop of 1420, target of 1500. And KPIT is a sell with a stop of 220, target of 206. Now, if we gap down again for some reason tomorrow or on Monday, and we go to 10,275, 300, from there you will get your substantial rally.
Okay.
So try to trade the boundaries instead of midway. Today we turned from like 10,380. Hence, you know, a great bounce back was not engineered.
Okay. Well, what about on PSU banks particularly, Ashwani? I mean, later this evening we'll have SBI's numbers. There's an expectation that because they're announcing their numbers for the first time post-market hours, we could get something ugly. Does it make sense to short any of the PSU banks now? Or do you think, you know, it's better to just be away from that pocket?
No, ugliness impacts people of great beauty. So I don't think that will really matter. It's hanging around the 200-day moving average. All PSU banks have been dead and buried. Even if you get good results in this kind of a banking mood, you know, you will find selling at higher levels. Say it opens up 2-3% higher, you will again find selling, because chances are whoever is selling the other banks maybe has SBI also. So you don't want to get brave in front of these sort of numbers.
Okay, Mitesh, what about you? What would you buy or sell today for a reverse trade on Monday?
So, in fact, I have two sell calls. Yes Bank is a SPVT and banking lot. We're just highlighting that. So, keep the stop at 330. Look for a 316 kind of a target. And Tata Motors, after a long time, appears to be closing below this 370 zone. So, keeping a stop at 375. Sell for targets of 356.
Okay, that's some BTST calls. Let's get our next guest then. Mohammad Ababhai from Citi is with us now. Of course, there's a lot of market volatility. Earlier in the day, of course, you heard from Mohammad when he was talking to the CNBC Asia network about you know, what could be going wrong over there. But Mohammad, good afternoon. Your views on India in particular for 2018. The FI flows have been tepid. In fact, we have seen a lot of outflows once again. So, do you think this is a buying opportunity, or do you see something worse?
Well, I think for India at the moment, it's not going to be immune from the global volatility that we've been seeing. The foreign investors were looking at India. The budget didn't really help the sentiment of foreign investors. But I think this sell-off that we're seeing at the moment has got actually not a huge amount to do with the budget, but more to do more with the sentiment in the global markets and the way that volatility has risen across global equities, global bonds, and also in the foreign exchange market, argues for really a position reduction. And remember, people have been buying into these markets for 2 years, and really there's a limited window now where they've gone out. You know, we've given back probably three months of gains, certainly the gains from the beginning of the year. Even in the space of 3 or 4 days, those gains have been given back. So most people are still have not exited those positions. They're still sitting long and are now sitting there nursing losses and wondering what to do about them.
So what have you made of the Indian macros, Apabhai? With bond yields close to 8%, is there a possibility of a rate hike as well by the RBI later this year?
Yeah, I think the interesting thing about India has been that there is a very strong correlation between India and the global central bank balance sheet. So I think although there may be a correction right now, I think in the medium term I'm probably still a bit bullish. But I think what we need to do is we need to see the decoupling of India away from these global inflows. I think this really then comes down to a big macro call on a global basis about whether QE will be extended or not. My view is actually that QE will be extended either from Europe or from Japan, or there'll be a fresh reiteration of that liquidity. And what that will do is actually set up the vehicle for India to be rallying again. But I think what needs to happen before we get there is some of the positions that have been built up since the beginning of the year, some of the exuberant buying that we've seen has really got to be unwound, and we've really not seen very significant signs of that actually happening. So far it's very much the hedge funds, the quant funds that seem to be driving this market rather than fundamental money or even retail money.
Okay, what about the FII money? I mean, just to come back to that point, do you see a move away from equities to debt, maybe because of LTCG?
Not necessarily. I think India still has the demographic story in its favor. It's still got one of the highest growth rates in its favor. So foreign investors are still attracted to that, and at the end of the day, they like earnings growth. And so as India performs on, what is most important is that India performs on earnings growth. I think what the capital gains tax does do, though, is it means that whenever you're looking at your models and you think, okay, I'm going to make a 10% gain, well, actually, you're only making a 9% gain. And what that means is that on a risk-reward perspective, you're actually ending up allocating a little bit more to bonds than you are to equities. But it's really a marginal decision. I think the other thing as well to note is that India is not the only country in the world with which taxes capital gains. You know, the UK, Australia, these countries are all have a capital gains regime. So people get used to whatever taxation there is. I think what the bigger concern is really what signals that the government may be sending out in terms of the welcomeness of, or the welcoming of foreign capital into the market. But I think the grandfathering of capital gains has actually been a very significant step, and the clarification that we received from the government last weekend was actually a very welcome step, that even foreign investors would have their capital gains grandfathered when it comes to capital gains purposes. But I think overall what it does is in global portfolios, if you're running bonds, equities and cash, it probably moves you a little bit away from equities. Now with the sell-off, I mean, it's within the margin of error, so I don't think it's actually a very significant decision-making component.
So what are you making of the recent volatility on global markets, Apabhai? Historically, bull market corrections see around a 12 to 13% pullback. US markets are now down 10% from their peak. Is there a risk of more than, say, a 20% downside as well?
Well, I think if you saw more than 20% downside for the market, then you'd probably be looking at a recession in the US. If you believe that that scenario is coming about, and I don't think I believe that at the moment, but if you did believe that, there's much bigger trades, not only in the equity markets, but in many asset classes as well. For example, the credit markets are not pricing in anything like that happening at all. If you believe that that was the case, then US 10-year yields would not be heading towards 3%, they'd probably be heading towards 1%. So at the moment, if that is the scenario that people are looking at, then, and I don't think many people are, then that is a problem. I think the thing is that the central bankers also know that there is this potential for reflexivity. That is the idea that the fall in the equity market can actually cause contagion in various other markets. We have an indicator which we call the key rate, which actually has been elevated over the last few weeks. And what that has, it's actually at the highest level since the European credit crisis in 2012. So we are watching for something which is a bit more systemic at the moment, but we're not actually seeing it. we are recommending that people hedge their positions, but we do think that the central bank liquidity put will be around. We think it's another probably 6% down on a closing basis, maybe about 8 or 9% down on an intraday basis in US markets, probably up to 10% down in Asian markets, especially in illiquid conditions. But really what that will do is confirm that really apart from this central bank liquidity game, there isn't actually anything else going on. The big question for investors for 2018 is really whether you believe that the global economy has reached escape velocity, i.e. that if you remove the global central bank liquidity, that growth can continue. My view has been that there is no evidence for that whatsoever, at least coming from the equity market and the other markets as well. And we shouldn't be relying on that as an investment thesis for 2018.
Okay, now the other big important point. What's the City House view in terms of the Fed rate hike cycle in 2018?
My understanding of the City House view is that we still believe that there's another 3 rate hikes coming in the US. I think though that if there's a very significant sell-off in the equity market, from a trading perspective, what we are recommending clients to do is to buy Fed fund futures for January 2019 and potentially sell Eurodollar futures for January 2019 as well, i.e. that if the equity markets sell off, then the Fed will either be forced to postpone rate hikes, and also what they will do is probably talk a lot more dovish. So what is actually happening now is that the equity market is in the seat of driving the outlook for some of those other markets. But we think for the time being that the liquidity put will remain intact. They'll probably talk dovish in the short term, and then once things recover again, we'll probably go back to what they wanted to do in the first place anyway. And we've seen examples of that in 2014 and 2016 as well. So my view is really that nothing has really changed in the world. It's the same old, what we've been seeing for the last 8 years will continue. It's still a matter of global liquidity and the central bank put, and that remains intact. And while that is, then we carry on going higher in equity markets, and we carry on going higher in bond markets as well.
What did you make of the RBI monetary policy? If rates do go up and inflation is higher, do you think equities could lose its sheen in the near term?
Yeah, I'm a little bit cautious on the outlook for inflation. I think that inflation is probably not going to be taking the upward trajectory that some people think it's going to be. So I'm not in the camp of people who believe in the runaway inflation story. I think what is very important though is that calm returns to the foreign exchange market. We think that there's been a lot of movement in Eurodollar, dollar yen, some comments from Treasury officials, in US officials that have been interpreted as being very dovish on the dollar. And that really, we think, has been the root cause of the turmoil that we're seeing right now. Those comments created an increase in foreign exchange volatility that's fed into rate volatility and then into equity volatility. So some calmness in the foreign exchange market and a reversion to the Shanghai Accord will actually be quite welcome for global markets. In terms of the RBI, we think that it will be a fairly steady picture. We have confidence in the RBI to manage both the rate side as well as the foreign exchange side as well. And really the foreign inflows, we think after this buyer's strike and temporary illiquidity that we're seeing in markets will actually return.
Just about 6 minutes left for the day and the week to come to an end. Dilip Bhatt, the joint MD of Prabhudas Lilladher, now joins in. And of course, we have been speaking with our technical experts as well. Dilip, hi, afternoon. There's been so much global chaos, but amidst all of that, there have been some really good numbers that have come in from the mid-cap space. Whether it's names like Page Industries, Heidelberg Cement, gold finance companies, anything from the mid-cap or non-index large-cap space that you liked, that maybe you could, even expect to see further highs in the market?
Sure, I think the mid caps have maintained somewhat better results in terms of the expectations. They have really maintained that at the moment. And I think within that pack, some of the things which possibly look pretty interesting, I think it's something like IPCA looks pretty good from the current levels. And maybe if you're talking about something like 8 to 12 months, that looks pretty interesting. I think KEC is another company which has come out with some very good numbers. So we like KEC quite a bit. I think on a longer term basis, we feel that based on the order book, the current EBITDA margins that they have, and how this current year also 18-19 is going to roll out, I think KEC looks pretty interesting. CSC is another stock which has come out with results, and that's another company I think one should buy for a slightly longer term, 12 to 15 months. I think that's there is another good story, good annuity business, good cash flows. I think that's a story which we also like, and I think one should buy into that.
By the way, India Cement's numbers flashing on the screen, the market first reacted to only the net profit number, which is 15 crore compared to the poll of 21 crores. But there could be some extraordinary over there. Revenue may not matter too much for cement company, but the EBITDA number and the EBITDA margin number is actually better than what the street thought. So just pull out the the numbers. I think we flashed the EBITDA number as well and the EBITDA margin number as well. Let's have those flashes back as well. 167 crore is the EBITDA versus CNBC TV18 poll of 158 crores. So that's slightly better than the estimate. Margin as well, 13.8% versus 12.2%. So will be interesting to see where this net profit miss is coming from. Could be a tax issue, could be something else. But anyway, the market right now is closing, so just about 4 minutes left. So not reacting too much on that. But Dilip, hi, good afternoon. Quite a bit of volatility in the large caps, but mid caps seeing buying action. Your thoughts on this whole global volatility and the impact on Indian market. Do you think we could see a bit of a decoupling from here on, or do you think we remain vulnerable if the US markets go through another bout of selling?
It's difficult to imagine that we'll be decoupling from the international events and the international markets, because for last 2 years, I think the US has taken care of the global markets, including India, despite India not really having all that great corporate earnings, and yet we have seen that Indian markets have been more or less in the northern trajectory. But I think we, without any doubt, one has to acknowledge that volatility is here to stay, because too many things moving at the moment, whether it's US bond markets, whether the dichotomy between the reverse repo rate and the bond yields which are existing even over here. I think all this point towards the fact that yes, markets are confused at the moment, but by and large, I think I would still remain bullish on a slightly longer term, maybe a month or two here and there, and maybe it would be the time to accumulate and gradually buy into the markets. But I think on a longer term basis, say next 8 to 12 months, I think it should still give, I still think that Nifty can touch 11.5 to 12,000. That is very much possible. And if that is the course Nifty can take, as per what I'm thinking, I think there's a good money to be made overall in the markets.
Okay, losses galore for all the PSU banks. Look at UCO Bank, NII down, but look at that big net loss there. Huge gross NPAs of almost 20%. No recovery at all in some of these PSU banking names. Of course, they've been huge wealth destructors, as we've been pointing out. But we just have 2 more minutes to go, so let's get some winding down comments for the day and the week. Ashwini, it's been a pretty hectic week. We've had so much stomach-churning moves in global markets and in our own. But, you know, we get a sense at the end of the week that the bears definitely have the upper hand. Do you get a feeling that next week could be same or equally worse?
See, we've had 2 weeks of expansion on both Nifty and Bank Nifty. Now, I won't be surprised if you get 1 week of sideways moves, which will be the range narrowing down. But I don't think, the downside is over. So let's see, maybe we are in a bit of a range, and that range could last for a bit. But overall, you'll see similar action. One day, large caps do very well, mid caps do nothing. The other day, mid caps do something, large caps don't do anything. So it'll be that kind of choppy type market where you identify boundaries and try to trade from those boundaries, because you cannot expand continuously for more than 2 weeks often, and the third week tends to be a sideways week. So let's see how next week goes.
Oh, absolutely. So I guess volatility is something that you can't run away from, right?
You can't. And I don't know if the bulls would be entirely unhappy with this week, Sonia, because, you're ending on the mid-cap index side 0.5% higher. So, in fact, all through January when the market was rallying, the mid-caps were falling. Now you have reversed that trend. Too soon to say that, but sometimes, market gives these hints. The kind of volatility that you've seen in US cannot continue forever. So, I don't know, I mean, if this is an indication from the market that maybe the market is now beginning to price in the worst, and around 10,300, 400, it's making a bit of a bottom, I think we'll find out. The next week is truncated week as well, so could be interesting. But in terms of stocks, the problem for the market is the large cap private financials. HDFC Bank, ICICI Bank, Axis, Yes Bank, all of these stocks ended at or near the low point of the day, and that's one pocket which didn't see any buying through the day, and that may get reflected even in today's FI numbers as well. So that's one pocket where clearly there is some incremental selling which is visible. Apart from that, Infosys was down a bit, Larsen was down a bit, so these stocks clearly put some pressure. Tata Motors is making a move back towards its 52-week lows. Eicher Motors was down a bit in trade. On the way up, HCL Tech, Cipla has been a stunning mover this week, 8% on that stock. Tata Steel ahead of numbers, Lupin up about 1%.
Well, it was good for the mid-cap index, you'd have to say. Plenty of buying opportunities. The mid-cap index closes with gains of 0.3%. The stock of the day undoubtedly was Fortis Healthcare. After the Singh brothers resigned from the board, there was a huge relief rally there, 18% higher on Fortis Healthcare. SAIL was not too far behind. Almost a 10% rally on SAIL. It reported profits for the first time on an operational basis, on the EBITDA basis. Indiabulls Real Estate, PE funds interested in buying the commercial assets over there, so that stock was in the green. On the downside, the stock of the day was Glenmark Pharma, down about 7.5% post-week numbers and weak commentary from the management. And a couple of other stocks, names like Idea Cellular, etc., fell a bit in trade, so those stocks were down about 2.5%. But with that, we will wrap up closing bell not just for the day but for the week. We'll see you again on Monday.